Hello, I'm David Cassidy. European equity markets are trading slightly firmer, although still volatile, this morning after the European Central Bank is showing that it will do whatever it takes to calm markets and help the economy by announcing a very large €750 billion quantitative easing programme. We learned from the global financial crisis, however, in 2008-2009 that the major central banks had to return several times with larger stimulus packages before confidence started to return. And thankfully, the European Central Bank has made it clear that it would up the ante again if needed. However, with the coronavirus outbreak still developing, which is keeping financial markets on edge and making volatility the new normal, there may also be the need for out-of-the-box measures to be considered, as extraordinary times require extraordinary action. For example, while the UK support package surpasses the US package in terms of gross domestic product, GDP, the UK package amounts to 15% of GDP compared to about 6% in the US. But the US package includes cash handouts, which are immediate and liquid, whereas the UK's are targeted loan-based schemes, which may be too restrictive and slower to feed through to the economy. Elsewhere, the pound, which was trading at $1.31 against the US dollar just 10 days ago, has fallen to $1.15, its lowest level since 1985. Although this weakness partly due to Brexit and coronavirus uncertainty, the US dollar is seen as a safer currency. While the outlook is currently uncertain, it's always darkest before the dawn, and we can't currently see how it can get much darker. With the global equity market volatility we've seen over the month, it wouldn't be surprising if you, like some of our clients, are anxious. And I would like to reassure you that the diversification, discipline and risk management form the cornerstone of our investment philosophy. Our long-term growth portfolios are diversified across a variety of asset classes, equities, fixed interest, cash, and geographies such as Europe, Asia and the US. Additionally, risk management is just as important to us as investment performance and returns. And the investment management team here work within a strict, controlled and disciplined process. Although our disciplined process hasn't stopped your portfolios from falling, it has helped to protect against bigger losses. For example, at last night's close of business, Wednesday the 18th of March, the FTSE 100 is now down 33.35% since the last valuation period on the 5th of January. While a typical cautious risk client portfolio is down about 16.72%, balanced about 23.59%, and adventurous around 24.53% over the same period. While we remain positive on equities over the long term, particularly those in Asia and emerging markets, we currently have a short-term cautious stance with a slightly higher than normal level of cash. However, given the market volatility, you may be wondering why we haven't increased cash holdings further with a view to reinvesting later. Well, we haven't, because here at MyWealth we take a longer-term approach to investing, because evidence shows that this leads to better outcomes, as time in the market is more important than trying to time the market. For example, this chart shows what would have happened to a £10,000 investment into the FTSE 100 when the index was first created at the end of 1983. As you can see, this 10,000 would at the end of February 2020 be worth £129,599. However, as you can also see from the next chart, if one tried to time the market and missed the best 5 days in the index's history, this 10,000 column 1 would have grown to 85,000, and simply missing those 5 days reduced the return by over £43,000. Likewise, if one missed the best 10, 30 or 50 days, the missed growth increases dramatically. As you can see, missing the best 50 days means 10,000 would have grown to just £13,469. While the negative impact from coronavirus is clearly an ongoing and developing story, we believe that this negative impact on the global economy and company profits is likely to be limited to the first half of 2020. And as a result, we believe that once demand picks up during the second half of 2020, global equity markets are likely to recover strongly. And obviously, a fully invested portfolio will benefit from this recovery. However, that doesn't mean that we have a simple buy and hold strategy, as we've been actively managing client portfolios. As you can see from the accompanying table, we have made a number of changes to our clients' discretionary portfolios over the past month, which has prevented the portfolios from falling further. We have reduced or sold holdings in companies where we believe coronavirus risks are pronounced, such as Burberry, Compass, Informa and Melrose Industries. For example, while we still believe in the long-term potential for cruises, given the growing middle class, especially in the emerging market countries like China, and an ageing social population, we have sold client holdings in Carnival Cruises due to the expected financial impact from the coronavirus outbreak, and will look to buy back the shares when value re-emerges. While it was painful to sell the shares at £20.24p as they were trading at over £40 this time last year, the shares are currently trading at £6.69p. Now, this sale has saved a typical discretionary balance portfolio nearly 40 basis points in investment performance. And these proceeds have been reinvested in more defensive companies such as Unilever, GlaxoSmithKline and Vodafone. Now, although some of these changes haven't contributed to performance, overall these changes have contributed at almost 1% to the performance of a typical balanced portfolio. While the path for financial markets is unlikely to be smooth, as we fully expect the market volatility will remain elevated in the short term, it is important to resist the urge for any knee-jerk reaction and maintain a long-term perspective by looking past the negative news headlines and negative economic data releases that will undoubtedly start to see as equity markets have weathered and recovered from lots of negative events in the past, and this time will not be any different.